Hello everyone, today's video all about capital gains tax and specifically a recent case before the tribunals on whether or not certain types of expenditure were an allowable deduction for CGT. So what happened was Mr. X had shares in a limited company and he sold those shares to this trust. So the shares moved from his control to the control of the trust. And basically, they did a deal with the trust, and the trust said, look, this company that we're going to acquire from you, it is full of debt. It is encumbered with debt, and basically, we want to do this deal where the company is free of debt. So, as part of the deal, he had to get rid of the debt, but there wasn't enough cash in the company to extinguish the debt, so he used personal funds to pay off the debt of this company before he sold it to the trust. So that was the deal, debt-free, unencumbered. Now, discharged the debt and he got a higher price. That was the deal of it, which you'd expect. The company was worth more without any debt, so he got a higher price from the trust when he sold this company, unencumbered. But of course, when he got a higher price, it was more capital gains because the difference capital gains tax, you've got your difference between your sales price and what you bought it for, assuming he set this up from scratch, bought it for a negligible amount, like £1, sold it at the higher price because it was unencumbered. So he had a higher capital gain because he had to get rid of the debt. So he thought, what if I knock off as a cost, as an expense of the capital gain, the fact that I incurred the expense of extinguishing the debt? So in his CGT calc, he claimed a deduction for the cost of discharging that debt before he sold it, saying, look, this is a allowable deduction. It's an incidental cost of sale. Now, incidental costs of sale would be things like legal fees or accountant's fees in association with selling shares in a company. So that is incidental cost of sale. Now, extinguishing a debt before, in order to enable a sale to take place, was not an incidental cost of sale in HMRC's eyes, and it was tested at the tribunal. And the tribunal sided with HMRC and said, yeah, that is not an incidental cost of sale, nor indeed is it an enhancement of expenditure. A bit like, say, if you sold a property, a buy-to-let property, and the gain would be the difference between what you sold it for and what you bought it for, but you'd also get relief against the gain for enhancement expenditure. If you'd, say, built an extension at some point between buying it and selling it, that would reduce the capital gain. So he also argued that it was a kind of an enhancement expenditure, and the tribunal said, no, it's not at all. It's not enhancement expenditure, it's not peripheral cost of sales or incidental cost of sales, you're not having the tax relief. Tribunal decided for HMRC. So a bit cute there. I think it was trying it on a bit, really. I mean, I would have thought it's blatantly obvious that, cost of releasing that debt on behalf of the company was not going to count as a taxable deduction for CGT. But anyway, he had a go. He lost, but there you go. So interesting case just on the tax deductions that are associated with capital gains. If you like this video, please do subscribe. And as always, I'll see you soon.